Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional, financial, or legal advice. Laws surrounding retirement accounts and domestic relations are complex and vary significantly by state. The historical trends and potential outcomes discussed here should not be taken as a guarantee of future results. Always conduct your own due diligence and consult with a qualified attorney or financial advisor regarding your specific situation before making any decisions related to your 401k or divorce proceedings. Imagine working for 35 years, diligently contributing to your 401k every single pay period, passing up vacations and luxury purchases to ensure your future is secure, only to realize that a single signature on a divorce decree could instantly reallocate 50% of that lifetime effort to someone else. In the United States, the 401k is often the single largest asset a couple owns, frequently surpassing the equity in their primary residence. Yet, most Americans have no idea that the 401k was never actually designed to be a primary retirement vehicle, let alone one that would be litigated in the emotional furnace of a divorce court. We are currently living through a historical first. The first generation of retirees who are attempting to untangle 40 years of defined contribution savings during a period where gray divorce rates have hit an all-time high. This is the story of how a tax code loophole became the center of the American family unit and why, if you aren't careful, the history of the 401k could become the blueprint for your financial undoing. In this deep dive masterclass, we are solving the mystery of the Qualified Domestic Relations Order, or the QDRO. For most, this is just a 5-letter acronym, but for anyone going through a divorce, it is the most powerful legal instrument in their arsenal. Today, we are going to unpack the historical evolution of retirement assets in the U.S. and explain exactly how the shift from corporate pensions to individual 401ks changed the stakes of marriage and divorce forever. By the end of this series, you will understand the mechanics of asset division, the tax implications of early withdrawals during a split, and the historical precedents that judges use to determine what is yours, what is theirs, and what belongs to the IRS. To understand why a 401k is so volatile in a divorce today, we have to look back at the landscape of 1978. Before the Revenue Act of that year, the American retirement dream was built on the three-legged stool: Social Security, personal savings, and the employer-funded pension. Under the old pension system, divorce was relatively straightforward regarding retirement. Since the company managed the fund and paid out a set monthly check upon retirement, the asset was essentially a future promise of income. Dividing a promise is a lot different than dividing a liquid, fluctuating brokerage account. When Section 401k was added to the Internal Revenue Code, it wasn't intended to replace pensions. It was designed as a way for high-level executives to defer some of their bonuses into a tax-advantaged account. However, by the early 1980s, benefits consultants realized that this tiny provision could be expanded to all employees, shifting the burden of retirement funding from the employer to the employee. This shift fundamentally changed the nature of marital property. Suddenly, instead of a communal promise from a corporation, a couple had a tangible, growing pot of cash that sat in one spouse's name but was legally considered community or marital property. Consider the case study of a typical American couple in the mid-1980s. As companies began freezing their traditional pension plans and offering 401k matches instead, the wealth of the family became localized in these individual accounts. If the husband worked at a manufacturing plant for 20 years and the wife stayed home to raise children, the 401k would be in his name, tied to his social security number, and managed by his employer. Historically, this created a massive power imbalance during a divorce. Without specific laws to govern how these accounts should be split, many stayed with the named account holder, leaving the non-earning spouse in a state of financial peril. This historical inequity led to the passage of the Retirement Equity Act of 1984. This was the moment the QDRO was born. Before 1984, the Employee Retirement Income Security Act (ERISA) actually prohibited the assignment or alienation of benefits. This meant that, technically, a plan administrator could refuse to pay out a portion of a 401k to an ex-spouse because the law said the money belonged to the employee, period. The 1984 Act changed the game, creating a legal pathway for a state court to order a federal retirement plan to pay a portion of the assets to an alternate payee. Understanding this history is vital because the 401k is governed by federal law, while divorce is governed by state law. This creates a massive friction point. If you are in a community property state like California or Texas, the law generally views any wealth acquired during the marriage as owned 50-50, regardless of whose name is on the account. In equitable distribution states, the court looks at what is fair, which might not be an even split. However, because of the historical precedent set in 1984, the federal government essentially defers to the state court's decision, provided a QDRO is properly drafted. Let's look at the data regarding how these assets have scaled over time. In 1990, total 401k assets in the U.S. were roughly $384 billion. By 2023, that number surged to over $7 trillion. Because so much of the American middle class's net worth is now tied up in these accounts, the 401k has become the primary battleground in modern divorce. Unlike a house which can be sold and the proceeds split, a 401k is a living, breathing investment. If a couple decides to divorce during a market downturn, the historical trends show that the timing of the valuation date can result in a difference of tens of thousands of dollars. For example, if a 401k is valued at $500,000 on the day the divorce is filed, but the market drops 20% by the time the QDRO is processed 6 months later, who bears that loss? Historical case studies show that unless the divorce decree specifically accounts for market fluctuations, the spouse who is supposed to receive a flat dollar amount might end up with a much larger percentage of the remaining pie than originally intended. Conversely, if the market rallies, a flat dollar amount award might result in the non-account holding spouse missing out on significant gains that occurred during the litigation process. Furthermore, we must address the premarital seed historical analysis. One of the most complex parts of a 1,000-word deep dive into 401k history is the concept of tracing. If you started your 401k in 1995 but didn't get married until 2005, only a portion of that account is marital property. The growth of the premarital portion during the 10 years of marriage is often a point of intense legal debate. Does the non-earning spouse get a share of the interest earned on money that was put in before they even met? Historically, different states have reached different conclusions. Some argue that the passive appreciation of premarital assets remains separate property, while others argue that if marital funds, the employee's paycheck during the marriage, were commingled with the premarital funds, the whole account becomes marital property. This complexity is why the 401k is the most dangerous asset in a divorce. It is a pre-tax asset. If you have $100,000 in a savings account and $100,000 in a 401k, they are not worth the same amount. The $100,000 in the savings account is post-tax money. You've already paid the government. The $100,000 in the 401k is a looming tax bill. Historically, many spouses have made the mistake of trading the house for the 401k, thinking they were getting an equal dollar value, only to realize later that they owe 25% of that 401k to the IRS the moment they try to use it. By examining these historical shifts, from the 1978 tax code change to the 1984 Retirement Equity Act, we can see that the 401k was never meant to be this complicated. It was a simple executive perk that evolved into the bedrock of American retirement, and in doing so, it became the most complicated puzzle piece in the history of U.S. domestic relations law. In the next sections of this masterclass, we will move from the history to the hard mechanics of how these funds are actually moved without triggering massive penalties. To understand how 401k funds move during a divorce without triggering the devastating tax traps that have historically ruined family balance sheets, we have to look at the mechanics of the transfer process itself. In the modern landscape of 2026, the complexity has only increased as more Americans hold multiple accounts from various employers throughout their careers. If you simply withdraw the money to hand it to an ex-spouse, the IRS views that as a taxable distribution. For someone in a high tax bracket, that could mean losing nearly 40% of the value to federal and state taxes, plus a 10% early withdrawal penalty if the account holder is under the age of 59 and a half. This is where the historical development of the Qualified Domestic Relations Order becomes a literal lifesaver for your net worth. Imagine a scenario involving a project manager named Michael and a teacher named Sarah. They are finalizing their divorce in 2026 after 15 years of marriage. Michael has a 401k worth $600,000. Through their negotiations, they agree that Sarah is entitled to $300,000 of that account. If Michael simply writes Sarah a check from that account, the financial fallout would be catastrophic. He would be responsible for the income tax on that $300,000, likely pushing him into the highest possible tax bracket for 2026, and he would be hit with a $30,000 penalty for early withdrawal. By the time the dust settled, that $300,000 payment might cost Michael $450,000 in total account value, while Sarah only receives a fraction of the intended amount after her own tax considerations. The solution that evolved out of the 1984 Retirement Equity Act is a step-by-step legal bridge that bypasses these penalties. This process begins with the drafting of the QDRO. It is important to understand that a divorce decree is not a QDRO. This is a common historical mistake that has led to years of litigation. A judge can sign a divorce decree saying the 401k is split 50-50, but a 401k plan administrator, who is governed by federal ERISA law, is under no obligation to follow a state court divorce decree. They only answer to a QDRO. Step 1 in this mechanical process is the identification of the plan administrator. Every 401k plan has a summary plan description that outlines the specific requirements for a QDRO. Historically, many attorneys failed to realize that every company, from Google to a local construction firm, has different rules for how they want a QDRO to be formatted. If the wording is not exact, the plan administrator will reject it, sending the couple back to square one. In 2026, many large financial institutions have automated this, but the legal nuances remain. Step 2 involves the actual drafting of the order. This document must contain specific information: the name and last known mailing address of the participant and the alternate payee, the amount or percentage of the participant's benefits to be paid to the alternate payee, and the number of payments or the period to which the order applies. Imagine if Sarah's attorney drafts an order that simply says Sarah gets half. The plan administrator might ask, half of what? Half of the balance on the day of separation? Half of the balance on the day of the final decree? Or half of the balance including any gains or losses until the date of distribution? Case studies from the early 2000s are filled with horror stories where a lack of specificity led to one spouse receiving significantly more or less than intended because of a market swing during the 3 months it took to process the paperwork. Once the QDRO is drafted, it is sent to the plan administrator for a preliminary review. This is a critical historical safeguard. The administrator checks to see if the order seeks to provide any type or form of benefit, or any option not otherwise provided under the plan. For instance, if a QDRO orders the plan to pay Sarah a lump sum, but the plan only allows for monthly installments, the order is invalid. This interplay between state-level domestic desires and federal-level corporate rules is where most 401k divisions fail. Step 3 is the court's signature. After the plan administrator gives a preliminary thumbs up, the document goes to the state court judge. Once signed, it becomes a formal court order, which is then sent back to the plan administrator for final qualification. It is only at this point that the account is legally divided. Now, we must examine the unique historical provision known as the 401k divorce exception. Under Internal Revenue Code Section 72T(2)(c), payments made to an alternate payee under a QDRO are exempt from the 10% early withdrawal penalty. This is one of the very few instances in the entire U.S. tax code where you can access 401k funds before retirement age without a penalty. For Sarah, this presents a strategic choice that many in 2026 are forced to make. She can roll her $300,000 into her own IRA, where it will continue to grow tax-deferred until she retires. Or she can take a cash distribution. If she takes the cash, she still owes income tax on it, but she avoids that 10% penalty. Historically, this has provided a vital lifeline for non-earning spouses who need immediate liquidity to buy a new home or pay for legal fees following a split. However, a massive trap exists here that we must discuss. This exception only applies to 401k plans and other qualified employer plans. It does not apply to IRAs. If Michael had rolled his 401k into an IRA before the divorce was finalized, and then tried to pay Sarah out of that IRA, the 10% penalty would apply. This historical nuance has led to a specific strategy in modern American divorce. Never roll a 401k into an IRA if a divorce is on the horizon. The 401k offers a level of flexibility in a legal split that the IRA simply cannot match. Furthermore, we need to look at the data regarding the time it takes to execute these moves. Historically, the gap between a divorce decree and the actual funding of an alternate payee's account is 4 to 12 months. During this window, the account participant often retains investment control. Imagine if Michael, feeling bitter about the split, decides to move the entire 401k into high-risk, speculative assets in 2026, and the account loses 30% of its value before the QDRO is finalized. This is known as dissipation of assets. Courts have historically looked unfavorably on this, but proving intent can be a grueling and expensive legal battle. To mitigate this, Modern QDROs often include language that freezes the account or requires the participant to maintain a specific investment allocation until the transfer is complete. This brings us to the concept of the segregated account. Once the plan administrator qualifies the QDRO, they typically move Sarah's portion into a separate account under her name, but still within Michael's employer's plan. She then becomes a participant in her own right, with the ability to choose her own investments until she decides to roll the money out. But what happens if the company Michael works for goes bankrupt during this process? Or what if Michael takes a loan against his 401k 3 weeks before the divorce is filed? These are the real-world variables that turn a simple math problem into a financial nightmare. Historically, 401k loans are treated as a distribution. If Michael owes $50,000 to his 401k, that debt is usually subtracted from his portion of the marital pie, but it complicates the total valuation. If the total account is $600,000 with a $50,000 loan, is the marital asset $550,000 or $600,000? The answer depends entirely on the historical precedents of the state where the divorce is filed. As we have seen, the movement of these funds is a high-wire act. One wrong word in a legal document, one misunderstood tax rule, or one poorly timed investment shift can erase years of compounding interest. But even if you master the mechanics of the QDRO, there is a deeper, more hidden danger lurking in the shadows of the 401k. It is something that many lawyers miss and most couples never consider until it is far too late. It involves the silent killer of retirement equity, the difference between a defined contribution plan and the remnants of the old pension systems, and how the IRS views them when they are combined. In the next part, we are going to dive into the nightmare of the double dip. We will explore how courts handle the overlap between 401ks and Social Security offsets, and why your 401k might be worth significantly less than you think when compared to your spouse's future government benefits. If you think a 50-50 split is fair, you might be surprised to learn how the historical context of Social Security can turn a fair split into a total financial imbalance. The illusion of a 50-50 split is perhaps the most dangerous trap in the history of American matrimonial law. To understand why your 401k might be worth significantly less than your spouse's future benefits, we have to look at the invisible weight on the scale: Social Security. In the United States, by federal law, Social Security benefits are not divisible in a divorce. While a 401k is a private asset that a state court can slice down the middle, Social Security is a federal entitlement program. This distinction has created a historical imbalance that has caught thousands of divorcing couples off guard, particularly those where one spouse has a high-value 401k, and the other has spent a lifetime in the public sector. Imagine the scenario of David and Linda, a couple divorcing in 2026 after 30 years of marriage. David has spent his entire career in the private sector, accumulating a 401k worth $800,000. Linda, however, has been a dedicated public school teacher for 3 decades. Because Linda is part of a state teacher's retirement system that opted out of Social Security, a common historical occurrence in states like California, Texas, and Illinois, she does not pay into the federal Social Security system. Instead, she will receive a robust state pension. When they go to court, the judge looks at David's 401k and sees $800,000 of marital property. But when the judge looks at Linda's future Social Security benefits, they see zero, because Social Security is off the table. This creates a massive mathematical distortion. If the court simply splits David's 401k 50-50, Linda leaves with $400,000 plus her full teacher's pension. David leaves with $400,000 and his future Social Security check. Historically, however, many states have recognized that this is fundamentally unfair. This led to the development of the Social Security offset. Some courts will calculate the hypothetical Social Security benefit that a spouse would have received if they had been in the private sector, and then subtract that value from the other spouse's 401k before dividing it. But this is not a federal requirement. It is a patchwork of state-level case law that varies wildly from one jurisdiction to another. The historical trends show that without a deep understanding of these offsets, the spouse with the 401k often ends up subsidizing the other spouse's retirement twice, once through the direct split of the account and a second time because their Social Security is invisible to the court while the 401k is transparent. This is the hidden math of 2026. As 401k balances have grown due to decades of market appreciation, they have become more appetizing targets in litigation, while the structural safety nets like Social Security remain shielded behind federal protections. Another layer of this masterclass involves the historical evolution of the valuation date. In the early days of 401ks, accounts were often valued once a year. In 2026, we see real-time fluctuations that can swing a balance by tens of thousands of dollars in a single afternoon. If a court orders a split based on the value of the 401k on the date of the divorce filing, but the market crashes before the QDRO is processed, the participant's spouse might find themselves owing a fixed dollar amount that now represents 70% of the remaining account rather than 50%. Consider the case study of James, who held a $1 million 401k heavily invested in tech stocks during a period of high volatility. His divorce decree stated that his ex-spouse was to receive exactly $500,000. During the 6 months it took for the plan administrator to approve the QDRO, the tech sector took a major hit, and the account dropped to $700,000. Because the decree specified a flat dollar amount rather than a percentage, James was still legally obligated to pay the $500,000. He was left with $200,000, effectively losing 80% of his share of the marital growth due to a simple phrasing error in the legal documents. Historically, the use of percentages rather than fixed dollar amounts has been the primary way to protect against this potential outcome, but even this requires meticulous drafting to account for interim contributions and loan repayments. Step by step, the calculation of the marital portion also requires a look at the coverture fraction, often referred to as the Hunt formula or the Majoska's formula in different states. This is the historical method used to separate what was earned during the marriage from what was earned before or after. The numerator is the number of months the participant was in the plan during the marriage, and the denominator is the total number of months the participant has been in the plan up to the date of valuation. Imagine if David started his 401k 5 years before marrying Linda, and continued it for 25 years during the marriage. The coverture fraction would be 25 divided by 30. Only that specific fraction of the $800,000 is considered marital property. However, in 2026, many financial experts argue that this simple linear formula is historically outdated because it doesn't account for the power of compounding interest. The dollars David put in during those first 5 years as a single man have had 30 years to grow. Under a simple coverture fraction, the marital estate gets the benefit of all that early compounding. Deep dive financial forensics are often required to trace the actual growth of premarital seeds, but for many middle-class couples, the cost of the forensic accountant exceeds the potential savings, leading them back to the simplified and often unfair historical formulas. Furthermore, we must address the specific mechanics of 401k loans in this historical context. In 2026, a significant percentage of Americans have outstanding loans against their retirement accounts. Historically, these loans are treated as an advancement of the participant's share. If David has an $800,401,000 but has a $50,000 loan out to pay for a kitchen remodel, the net value is $750,000. If the court ignores the loan and splits the $800,000, David is effectively being penalized twice. He has to pay back the full $50,000 loan with interest using post-tax dollars, but his ex-spouse receives a share based on a balance that included that borrowed money. This brings us to the most overlooked historical factor in 401k divorces, the survivorship provision. When a QDRO is drafted, it must specify what happens if the participant dies before the alternate payee receives their share. Historically, if the QDRO didn't name the ex-spouse as a surviving spouse for the purposes of the account, and the participant died the day before the transfer was finalized, the ex-spouse could potentially receive nothing. The money would instead go to the named beneficiary on the account, which might be a new spouse, a child, or even a sibling. This has led to the inclusion of qualified pre-retirement survivor annuity, or QPSA protections in modern orders. It ensures that the legal right to the 401k share is secured even in the event of an untimely death during the litigation process. As we peel back these layers, it becomes clear that the 401k is not just a bucket of money. It is a complex legal entity with its own history, its own rules of movement, and its own set of federal protections that can clash violently with state-level divorce goals. We have covered the history, the mechanics of the QDRO, and the invisible impact of Social Security and loans. But there is one final piece of this puzzle that is often the most contentious: the emotional and psychological warfare of the 401k. Why is it that people will fight harder over a 401k than they will over the family home? In the next part, we will explore the psychology of the nest egg, and the historical data on how 401k disputes often serve as a proxy for deeper marital grievances. We will also look at the rise of the silver divorce, and why the 401k is the ultimate weapon for spouses who are looking to secure their independence in their 60s. We are moving into the heart of the conflict, the intersection of human emotion and cold, hard tax law. The intersection of human emotion and cold, hard tax law is nowhere more evident than in the rise of the silver divorce. In 2026, we are seeing a historical peak in couples over the age of 55 ending long-term marriages. For these individuals, the 401k is not just a line item on a spreadsheet. It is the literal manifestation of their remaining life expectancy. When a couple in their 20s divorces, they have decades of human capital left to rebuild. When a couple divorces after 30 years, the 401k represents the only harvest they will ever get from their working lives. This creates a psychological state of scarcity that often turns a standard legal procedure into a high-stakes war of attrition. To understand the psychology of the nest egg, we must look at the historical data regarding the gender wealth gap in retirement savings. Case studies from the last 40 years consistently show that men, on average, tend to have higher 401k balances due to fewer career interruptions and historically higher wages. Conversely, women are more likely to have taken time off for caregiving, leading to lower individual balances but a greater legal claim to the household's primary account. In 2026, this often manifests as a deep-seated resentment during the QDRO process. The account holder often feels a sense of psychological ownership that the law does not recognize. They look at the 401k and see their late nights, their missed family dinners, and their professional sacrifices. The non-account holder looks at that same balance and sees the security they helped build by managing the household, a contribution that the American legal system historically treats as equal in value. Imagine a character named Robert, a senior engineer who has spent 30 years at a major aerospace firm. His 401k sits at $1.2 million. His spouse, Elena, worked part-time while raising their 3 children. As they enter the divorce process in 2026, Robert experiences what psychologists call the endowment effect. He values that 401k more highly because it is in his name and he was the one who physically performed the labor to earn it. When the court orders a $500,000 transfer to Elena, Robert doesn't just see a financial transaction. He sees a 30% reduction in his perceived self-worth and his ability to survive his old age. This leads to common historical behaviors such as attempting to hide assets or making risky investment moves to try and recoup the projected loss before the QDRO is finalized. This psychological tension is compounded by the historical reality of inflation and the cost of living. In 2026, a $1 million 401k does not provide the same lifestyle it did in the 1990s. When that million is split into 2 $500,000 accounts, both parties are suddenly thrust into a lower socioeconomic tier of retirement. This is the math of the silver divorce. One household becomes 2, but the retirement pot does not double. This leads to the phenomenon of the 401k proxy war. Instead of arguing about the emotional reasons for the split, couples fight over the valuation date of the 401k, the interest rates applied to loans, or the specific mutual funds being transferred. They use the complexity of ERISA law as a weapon to exert control in a situation where they feel they have lost all agency. The historical shift toward defined contribution plans has also created a new form of post-divorce anxiety, the loss of the survivorship benefit. In the old pension era, a spouse could be guaranteed a survivor annuity for life. With a 401k, once the money is split and moved into an IRA, that safety net disappears. If Elena takes her share of the 401k and the market enters a decade-long period of stagnation, she has no corporation or government entity to bail her out. She is now the sole investment officer of her own future. This realization often leads to intense litigation over who pays the QDRO drafting fees, which can range from $500 to several $1,000s in 2026. Historically, these fees were a footnote. Today they are a flashpoint. We must also consider the impact of the 401k on alimony, or spousal support, in a historical context. In many U.S. jurisdictions, there is a concept known as double dipping. This occurs when a court treats the 401k as an asset to be divided today, and then also considers the future distributions from that same 401k as income for the purposes of calculating alimony. Case studies in states like New York and Florida have historically struggled with this. If Robert gives Elena half of his $1.2 million 401k, should he also have to give her a portion of the monthly draw he takes from his remaining $600,000 once he retires? Many states have passed laws to prevent this, arguing that you cannot divide the same dollar twice. However, The 2026 legal landscape is still a patchwork of conflicting rules that require precise navigation. Furthermore, the 401k has historically served as a shield for the account holder. Because these funds are often locked away until age 59 and a half, some participants try to overcontribute to their 401k during the separation period to lower their take-home pay and reduce their potential alimony obligation. In 2026, forensic accountants use sophisticated software to track these contribution spikes. They look at the historical trends of the participants' savings. If Robert was contributing 5% for 20 years and suddenly jumps to the maximum legal limit of $30,000 the month after Elena moves out, the court will likely view that as an attempt to hide income. This brings us to the role of the plan administrator as a neutral, yet rigid, historical gatekeeper. The plan administrator does not care about Robert's feelings or Elena's sacrifices. They only care about the plan document. If the plan document says that no distributions can be made until the participant reaches age 55, even a QDRO might not be able to force an immediate payout to Elena. This creates a historical lag where Elena might be legally entitled to the money, but cannot touch it for 5 years. In 2026, with the cost of housing at record highs, this delay can be a death sentence for a newly single person's financial stability. As we analyze these case studies, a pattern emerges. The 401k is the ultimate equalizer in a U.S. divorce, but it is also the ultimate stress test. It tests the accuracy of legal drafting, the fairness of state laws, and the emotional resilience of the individuals involved. We have moved from the history of the tax code to the mechanics of the transfer, and now through the psychological warfare of the split. But there is a technical dragon we haven't slain yet. It is the most complex calculation in the entire process, and it is the reason why many 401k divisions are technically incorrect for years before anyone notices. In the next part, we are going to break down the actual math of interest and earnings on the segregated portion. When a judge says Sarah gets 50% of the account as of June 1, 2026, but the money isn't moved until December, who gets the dividends? Who gets the capital gains? And what happens if the participant takes a withdrawal in the meantime? We are going into the spreadsheet level of detail to show you how the big banks and plan administrators actually run the numbers when the court order is silent on the details. This is where the hidden thousands are won or lost. The hidden thousands are won or lost in the mathematical gray area between the date of valuation and the date of distribution. This is the stage where most legal professionals and divorcing couples lose track of the actual value of the asset. In the year 2026, with high-frequency trading and algorithmic market shifts, a 401k balance is a moving target. To accurately divide this asset, we must look at how investment earnings and losses are historically attributed to the alternate payee's share. If a court order states that Sarah is to receive 50% of Michael's 401k as of the date of their legal separation, but that order isn't processed for 9 months, who owns the market growth that occurred during those 270 days? Historically, there are 2 primary ways a plan administrator will handle this: with or without earnings and losses. If a QDRO is silent on the issue of investment experience, many plan administrators will simply pay out the flat dollar amount calculated on the valuation date. Imagine if Michael's account was worth $400,000 on the date of separation, and the court awarded Sarah $200,000. If the S&P 500 rises by 15% over the next year, while the lawyers are arguing over the paperwork, Michael's account grows to $460,000. If the QDRO does not explicitly state that Sarah's share should include gains and losses, Michael keeps the entire $60,000 gain, even though half of it was generated by money that legally belonged to Sarah. Conversely, if the market crashes by 20%, Michael would still be on the hook to pay Sarah $200,000 from a total pot that has shrunk to $320,000, leaving him with only $120,000. Case studies in 2026 show that the most precise way to handle this is through a segregated accounting method. This requires the QDRO to include specific language instructing the plan administrator to calculate the alternate payee's share as a percentage, and then apply pro rata earnings and losses from the valuation date until the date of actual segregation. This means Sarah's $200,000 would be treated as if it were in its own mini account within the plan, tracking the performance of the specific mutual funds or target date funds Michael has selected. However, a massive technical complication arises when we look at the historical data on account activity. What happens if Michael, as the account holder, takes a hardship withdrawal or a loan during the pendency of the divorce? Imagine Michael withdraws $50,000 to pay for his new apartment and legal fees. If the plan administrator later tries to calculate Sarah's 50% share of the original $400,000, they might find there isn't enough cash in the account to satisfy the order after taxes and penalties are withheld. This is why modern domestic relations orders in 2026 often include an anti-alienation or freezing clause. These clauses notify the plan administrator that a domestic relations order is being prepared and request that the account be locked to prevent loans or withdrawals. Historically, however, many plan administrators will not freeze an account until they have a court-certified copy of a draft QDRO in hand. This leaves a dangerous window of several weeks or months where one spouse can effectively drain the marital portion. We must also break down the math of the dividends and interest. Most 401k plans reinvest dividends automatically. If you are looking at a historical trend of a high-growth fund, a significant portion of the total return comes from these reinvested payouts. If the QDRO specifies Sarah gets the balance as of June 1st, but the dividend is paid on June 15th, the precise wording of the order determines if she gets a share of that payout. In the context of $1 million account, these quarterly dividends can amount to several $1,000s. Over a long litigation period, failing to account for these can lead to a significant wealth transfer from one spouse to the other by omission. Now, let's step into the shoes of a plan administrator at a major financial institution like Fidelity or Vanguard in 2026. When they receive a QDRO, they perform a historical look-back. They have to verify if the participant has any other outstanding QDROs from a previous marriage. This is a common point of failure. Imagine Michael was married before and a previous court order already carved out 20% of his 401k for his first wife. If Michael's current attorney isn't aware of this, they might draft a QDRO for Sarah for 50% of the total. The plan administrator will reject this because the total assigned benefits cannot exceed 100% of the account value. This historical layering of claims makes 401k division a forensic nightmare for those with multiple marriages. Furthermore, we need to examine the step-by-step process of tax withholding during a QDRO distribution. If Sarah decides to take her share as a cash payout instead of rolling it into an IRA, the plan administrator is legally required to withhold 20% for federal income taxes. If Sarah needs $200,000 for a house down payment, she cannot simply ask for $200,000. She has to account for the fact that the check she receives will only be for $160,000. To get the full $200,000 in her pocket, she would need the QDRO to award her approximately $250,000 to cover the tax liability. This is where many couples fail to communicate, leading to potential outcomes where the recipient spouse feels cheated because they didn't understand the difference between gross and net value. Data from the Bureau of Labor Statistics and various retirement studies indicates that the average 401k participant in 2026 holds between 15 and 20 different investment positions within their plan. When a QDRO orders a split, the plan administrator usually sells a proportional slice of every single holding. If Michael owns shares in a technology fund, a bond fund, and a real estate trust, the administrator sells 50% of each to create Sarah's new balance. This is historically the default method because it is the most neutral. However, it can create unintended consequences. If Michael had a specific investment strategy, the forced sale of half his assets might disrupt his portfolio's rebalancing or trigger a wash sale in a non-qualified account if he tries to buy the shares back immediately elsewhere. The complexity intensifies when we consider the historical context of employer matching contributions and vesting schedules. Many 401k plans have a 5-year vesting period. If Michael has been at his job for 3 years, he might have $100,000 in his account, but only $80,000 of it is vested. The other $20,000 belongs to the company until he hits his 5-year anniversary. How does a court divide money that isn't fully owned yet? Historically, some states treat unvested benefits as marital property, using a wait-and-see approach. In this scenario, Sarah would be awarded a percentage of the unvested portion, but she would only receive it if and when Michael actually reaches the vesting milestone. If Michael is fired or quits before that date, that portion of Sarah's award effectively vanishes. This historical uncertainty adds a layer of risk to the negotiation that a simple bank account split does not have. This technical deep dive into the math of earnings, losses, and vesting reveals why the QDRO is the most specialized document in the legal world. It is a bridge between the emotional chaos of a family breakup and the rigid mathematical reality of federal tax law. But even if you get the math right, and even if you account for the taxes and the vesting, there is another historical hurdle that can stop the entire process in its tracks. It involves the very nature of the employer itself. What happens if the company Michael works for merges with another firm while the divorce is ongoing? Or what if the 401k plan is terminated and replaced with a different type of retirement vehicle? In the next part, we are going to explore the chaos of corporate restructuring and how it can invalidate a QDRO that was months in the making. We will also look at the rise of the multi-employer plan and why dividing a 401k for a gig economy worker or a contractor is a completely different historical beast than dividing one for a corporate executive. The rules are changing, and if your legal strategy is based on the 1990s, you are playing a losing game. The 1990s legal strategy was built for a world of corporate stability that no longer exists in 2026. Historically, a worker stayed at one company for decades, and the 401k plan remained static under a single employer identification number. Today, the landscape is defined by constant corporate churn, mergers, acquisitions, and the rise of the gig economy. If your qualified domestic relations order is drafted with the assumption that the employer will remain the same from the date of filing to the date of distribution, you are ignoring one of the most significant historical trends in American labor: the death of the permanent corporate home. Imagine a case study involving a software architect named Christopher. In early 2026, Christopher and his spouse, Monica, begin the process of dividing his 401k, which is currently valued at $900,000. The account is held through Christopher's employer, a mid-sized tech firm. Monica's attorney drafts a QDRO specifically naming the tech firm 401k savings plan. However, while the lawyers are debating the valuation of the premarital portion, Christopher's company is acquired by a massive global conglomerate. As part of the merger, the old 401k plan is terminated, and all assets are rolled into the conglomerate's overarching retirement system. When the court finally signs the QDRO and sends it to the plan administrator, the order is rejected. Why? Because the tech firm 401k savings plan legally no longer exists. The assets have moved to a new entity with a different plan administrator, different plan rules, and a different investment menu. Christopher and Monica are now forced to go back to court, pay thousands more in legal fees to amend the order, and restart the approval process with a new corporate bureaucracy. This historical shift toward rapid corporate restructuring has made the successor and interest clause a mandatory component of any modern 401k division. Without language that accounts for plan mergers or terminations, a QDRO is a fragile document that can be invalidated by a single boardroom decision. Furthermore, we must look at the historical data regarding the gig economy and the rise of solo 401ks. In the 1980s and 90s, 401ks were almost exclusively the domain of large corporations. By 2026, millions of Americans are self-employed or work as independent contractors, utilizing solo 401k plans. These accounts present a unique historical challenge in divorce because the participant is often also the plan administrator. In Christopher's case, if he were a consultant with a solo 401k, he would be the one responsible for qualifying the QDRO against his own account. This creates a massive conflict of interest that historical ERISA law was never fully prepared for. Can a spouse be trusted to objectively evaluate a QDRO that takes half of their own money? Case studies in 2026 show that courts are increasingly appointing independent third-party fiduciaries to oversee the division of solo 401ks, to ensure that the participant doesn't use their administrative power to delay or obstruct the transfer. This adds a layer of cost and complexity that traditional corporate employees never have to face, but it is the new historical reality of the American workforce. Step by step, we also have to address the evolution of investment menus. Historically, a 401k offered a handful of mutual funds. In 2026, many plans offer brokerage windows, allowing participants to invest in individual stocks, exchange-traded funds, and even certain types of digital assets. If a QDRO orders a 50% split, but the account is currently holding volatile, illiquid assets or specific stock options, the mechanics of the slice become incredibly messy. Plan administrators typically prefer to liquidate everything to cash before splitting, but this can force a massive tax-inefficient event or lock in losses that the parties didn't intend. Imagine if Christopher's 401k was heavily invested in a specific sector that experienced a sudden, temporary downturn exactly when the plan administrator executed the liquidation for Monica's share. Historically, this has led to lawsuits where one spouse claims the other timed the divorce or the QDRO submission to sabotage the account's value. To navigate this, modern experts suggest using in-kind transfers where possible, meaning Monica would receive 50% of the actual shares of the funds Christopher owns, rather than the cash value of those shares. However, not all 2026 plans support in-kind transfers for alternate payees, especially if the alternate payee is moving the money to an external IRA. Another historical trend we must analyze is the missing participant phenomenon. As people move from job to job, they often leave behind small 401k balances at previous employers. By the time a divorce happens in 2026, a couple might be dealing with 4 or 5 different 401k accounts from a decade of career moves. Historically, many of these accounts are forgotten during the discovery phase of a divorce. If a QDRO is only filed for the current, active 401k, the non-account holder may be leaving hundreds of thousands of dollars on the table from previous jobs. This requires a historical audit of every W-2 and every employment contract since the date of the marriage. The 401k isn't just one bucket. It's a trail of breadcrumbs left across the American corporate landscape. This brings us to the issue of plan fees and administrative costs. Historically, the cost of processing a QDRO was absorbed by the employer as a cost of doing business. In 2026, however, most plan administrators charge a flat fee to review and qualify a QDRO, often ranging from $300 to $1,200. The question of who pays this fee, the participant, the alternate payee, or a 50-50 split, has become a standard point of contention in 2026 divorce settlements. While it seems like a small amount compared to the total balance, these fees are often deducted directly from the account, meaning they are paid with pre-tax dollars. If the court order doesn't specify how the fee is allocated, the plan administrator will often default to deducting it from the participant's remaining share, leading to further resentment and potential legal friction. We must also consider the historical impact of the automatic enrollment laws. Since the mid-2000s, many employees have been automatically enrolled in 401ks without ever making a conscious decision to contribute. This means that by 2026, many spouses are discovering they have significant marital assets they weren't even aware existed. In a high-stakes divorce, these accidental nest eggs can become major leverage. For example, if Monica discovers an old, automatically funded 401k from Christopher's first job out of college, she might use that discovery to negotiate a larger share of the equity in their home. The historical context of the 401k is a story of shifting responsibility. It shifted from the company to the individual, and now, in the 2020s, it has shifted from a retirement tool to a central piece of legal evidence. We have explored how corporate mergers can break your legal strategy, how solo 401ks change the rules of administration, and how the trail of old accounts can hide millions. But there is one final historical gatekeeper that stands between you and the finality of a divorce. It is a government entity that many people associate with taxes, but in the world of 401ks, they are the ones who decide if your split is actually a theft. In the next part, we are going deeper into the IRS's specific definitions of marital property versus separate property. We will look at the nightmare of the commingled account, where premarital savings, marital contributions, and post-separation growth are all swirled together in one historical soup. We will show you the specific math models the IRS looks for when they audit a QDRO distribution to ensure no one is bypassing the early withdrawal penalties. This is where we move from the corporate world into the high-stakes world of federal tax compliance. The difference between a smooth transfer and a massive tax penalty often comes down to a single date on a calendar. The difference between a smooth transfer and a massive tax penalty often comes down to a single date on a calendar. In the high-stakes world of federal tax compliance, the IRS does not care about the emotional narrative of your divorce. It cares about the classification of dollars. To navigate the 2026 tax landscape, we have to master the historical distinction between marital and separate property within a 401k. This is not as simple as drawing a line at the wedding date. The IRS and state courts look at the concept of commingling, which is the process of mixing premarital funds with marital contributions and then allowing them to grow together in a single volatile investment vehicle for 20 years. Imagine a case study involving a chemical engineer named Brandon. Brandon was a diligent saver. By the time he married his spouse, Kimberly, in 2011, he already had $200,000 in his 401k. During their 15-year marriage, he continued to contribute, and his employer continued to match those contributions. By 2026, the account has blossomed to $1.5 million. Kimberly is legally entitled to a portion of this account, but the question that haunts the 2026 legal proceedings is, exactly how much? If the court uses the historical simplified subtraction method, They might say that the original $200,000 belongs to Brandon and the remaining $1.3 million is marital property to be split. But this ignores the time value of money. Those original $200,000 were invested in high-growth funds in 2011. Even if Brandon had never added another cent during the marriage, that original seed would likely have grown to $600,000 or $700,000 on its own through passive appreciation. Historically, the IRS and state laws generally hold that passive appreciation on a separate asset remains separate property. However, the moment Brandon added marital funds, money earned while married, into that same account, he commingled the assets. In 2026, the IRS tracks these distributions with extreme scrutiny. If Brandon tries to claim that $700,000 is separate and only $800,000 is marital, he must provide a step-by-step forensic tracing. Imagine if, in 2018, Brandon took a loan from the 401k to pay for a family vacation. Did he borrow from the separate portion or the marital portion? When he paid the loan back with his paycheck, which was marital income, did that change the ratio of the account? This is the nightmare of the commingled account. Forensic accountants in 2026 use software to perform a historical look-back on every single transaction. But without clear records, the court often defaults to the most equitable outcome, which frequently results in the separate property being absorbed into the marital estate. Data from recent federal tax court cases suggest that the IRS is becoming increasingly strict about the timing of QDRO distributions. Under Section 72T, as we discussed, the 10% early withdrawal penalty is waived for a QDRO payment. However, if the timing is off, if the money is moved before the order is technically qualified or if it is moved into the wrong type of account, the IRS may view the entire transaction as a taxable event for the account holder. For Brandon, this could mean a tax bill of hundreds of thousands of dollars just for the act of trying to follow a court order. Step by step, we must also address the historical evolution of the separate property claim in community property states versus equitable distribution states. In a state like Arizona, the law historically presumes that everything in that 401k is community property, unless Brandon can prove otherwise with clear and convincing evidence. In 2026, the burden of proof has shifted. It is no longer enough to show a statement from 2011. You must show the continuous path of that money. If Brandon changed 401k providers or his company merged, and the historical records were lost in the digital transition, the IRS may not recognize his separate property claim, and neither will the state court. The math models for this are complex. One historical trend is the use of the direct tracing method, where every share of stock purchased before the marriage is tracked through every split and dividend. Another is the clearinghouse method, where all funds are treated as a fungible pool, and a pro rata percentage is assigned. Imagine the complexity if Brandon's 401k allows for a brokerage window where he bought and sold individual tech stocks. If he used marital income to buy a stock that went up tenfold, but he used premarital funds to buy a stock that went to zero, how do you balance the books? This brings us to the potential outcomes of the 2026 tax year regarding the required minimum distribution or RMD. Historically, RMDs were for the elderly, but with the Secure Act and its successors, the rules for inherited and divided accounts have shifted. If Kimberly receives a portion of the 401k via QDRO, and she is older than Brandon, her withdrawal timeline might be different than his. If the QDRO is drafted poorly, it might inadvertently force an RMD on Brandon earlier than he anticipated, based on the total balance before the split was finalized. Furthermore, we must look at the data on tax bracket jumping. When $1.5 million is split, the person receiving the cash distribution, Kimberly in this scenario, might find herself in the 37% tax bracket for the year 2026. This is a historical trap. Even without the 10% penalty, the federal income tax alone can devour nearly half the award. Case studies show that the most successful transitions occur when the recipient spouse spreads the distributions over multiple tax years, or utilizes a direct rollover to a traditional IRA. But here is the catch. Once that money hits the IRA, the QDRO penalty exception disappears forever. If Kimberly rolls the money into an IRA and then realizes 3 months later that she needs $50,000 for an emergency, she will now have to pay that 10% penalty because the money is no longer coming directly from a 401k under a QDRO. We also need to consider the historical context of the Roth 401k. In 2026, many employees have both a traditional 401k and a Roth 401k. The tax implications of dividing a Roth are the polar opposite of a traditional account. Since Roth contributions are made with after-tax dollars, the distribution is generally tax-free. If a court order simply says divide the 401k 50-50, but the account is 80% traditional and 20% Roth, which dollars go to whom? If Brandon keeps the Roth and Kimberly gets the traditional, Brandon has received a much more valuable asset on a net dollar basis. Historically, many attorneys failed to distinguish between these two buckets within the same plan, leading to lopsided settlements that only became apparent years later at tax time. As we dissect the IRS guidelines, it becomes clear that the 401k is a tax-deferred time bomb that a divorce court is essentially trying to defuse. We have looked at the dangers of commingling, the rigorous requirements of forensic tracing, and the traps of the early withdrawal penalty exceptions. But there is a final, even more technical layer to this discussion. It involves the person who actually signs off on these numbers before they ever reach the IRS. In the next part, we are going to look at the role of the valuation expert. We will explore why two different experts can look at the same $1.5 million 401k and come up with two different values that are hundreds of thousands of dollars apart. We will dive into the world of discount rates, mortality tables, and the projected future value of tax liabilities. If you think the number on your latest statement is the final word, you are about to see how the experts can make that number disappear or double with the stroke of a pen. This is the art of the 401k appraisal, and it is where the real negotiation begins. The real negotiation begins the moment you realize that the balance displayed on your 401k portal is not necessarily the value that will be used in a court of law. In the sophisticated financial landscape of 2026, the art of the 401k appraisal has become a specialized field where valuation experts and forensic accountants act as the final arbiters of marital wealth. To understand why your statement balance is a mirage, we have to look at the historical trends of tax affecting and the calculation of present value. When a valuation expert steps into a 2026 divorce case, they aren't just looking at what the account is worth today. They are looking at what it is worth after the IRS takes its share and after accounting for the loss of future compounding. Imagine a case study involving a healthcare executive named Jennifer and her spouse, Marcus. Jennifer has a 401k with a nominal balance of $2 million. In their 2026 divorce, Marcus's legal team argues that they should simply split the $2 million down the middle. However, Jennifer's valuation expert presents a different historical perspective. They argue that because every dollar in that 401k is pre-tax, the account is actually only worth $1.3 million in real-world purchasing power. This is known as tax affecting an asset. Historically, courts were hesitant to allow tax affecting because the future tax rate is technically speculative. However, in 2026, many U.S. jurisdictions have shifted toward a more realistic model, acknowledging that failing to account for the tax liability creates a massive windfall for the spouse receiving non-retirement assets like a house or a bank account. Step by step, the valuation expert begins by determining the projected tax bracket of the account holder at the time of retirement. This involves looking at historical income trends and the likely legislative future of the U.S. tax code. If the expert can argue that Jennifer will likely be in the highest tax bracket upon withdrawal, the present value of that 401k drops significantly on the balance sheet. For Marcus, this is a dangerous scenario. If he agrees to take the family home worth $1 million while Jennifer keeps the $2,401,000, but the court tax affects the 401k down to $1.3 million, the split looks equitable on paper. In reality, Jennifer has kept a much larger engine of wealth creation that will continue to grow tax-deferred for another 15 years. This brings us to the concept of the discount rate and the commingled growth analysis. As we discussed in previous parts, tracing premarital seeds is a forensic nightmare. In 2026, valuation experts use a method called the iteration of returns. Imagine if Jennifer started the account with $50,000 before she met Marcus. The expert doesn't just look at that $50,000, they apply the historical performance of the specific funds within that plan over 20 years to determine how much of the current $2 million is attributable solely to that original separate seed. This isn't just math. It is a battle of assumptions. If Marcus's expert uses a conservative 5% growth rate for the premarital portion, and Jennifer's expert uses an aggressive 9% rate based on the tech-heavy allocation of the fund, the difference in the final marital value can be hundreds of thousands of dollars. Another layer of this masterclass involves the historical use of mortality tables in 401k division. While 401ks are defined contribution plans, they are often compared to or balanced against defined benefit pensions. In 2026, Many high-net-worth divorces involve one spouse with a large 401k and another with a corporate or government pension. To compare the two, the expert must perform an actuarial valuation. They look at the life expectancy of the participants using updated 2026 Social Security and insurance tables. If Jennifer is statistically likely to live to 95, her 401k has a longer horizon to grow and provide income than if her life expectancy were lower. This data-driven approach turns a simple account split into a complex projection of human biology and market economics. Furthermore, we must address the historical trend of the lost opportunity cost. In some aggressive 2026 litigation strategies, lawyers argue that the participant spouse should be compensated for the loss of the tax-deferred growth on the portion that is moved out via QDRO. Imagine if Marcus takes $1 million out of Jennifer's 401k. Jennifer can no longer earn interest on that million. Over the next 20 years, that lost million could have potentially become $4 million. While most courts historically reject the idea of being compensated for future what-ifs, the negotiation often uses these projections as leverage to secure other assets, like a larger share of a brokerage account or a waiver of alimony. The 2026 valuation landscape also has to account for the liquidity discount.
A 401k is essentially a frozen asset.
You cannot use it to buy groceries today without a heavy penalty. Historically, $1 in a checking account has always been worth more than $1 in a 401k because of this lack of liquidity. Experts often apply a discount of 5 to 10% to the value of retirement accounts to reflect the fact that the money is not immediately accessible. If you are the spouse who needs cash now to restart your life, taking a larger share of the 401k might be a strategic error, as you are essentially trading liquid today dollars for restricted tomorrow dollars. Consider the data regarding the passive versus active appreciation debate. This is the front line of 401k divorce law in 2026. If Jennifer actively managed her 401k, frequently trading stocks and rebalancing based on her own research, some jurisdictions argue that the growth of her premarital portion becomes marital property because she used her marital effort to grow it. However, if she simply put the money in a target date fund and never touched it, that growth is considered passive and remains her separate property. In 2026, with the rise of automated robo-advisors and AI-managed portfolios, the line between active effort and passive growth has blurred. Valuation experts are now being asked to analyze the historical transaction logs of 401k accounts to see how much human intervention actually occurred. This technical warfare over the numbers leads to a critical realization. The QDRO is just the final delivery vehicle. The real work is done in the valuation report. If you rely on a standard brokerage statement, you are bringing a knife to a gunfight. You must understand that the historical precedents of your state dictate which of these expert theories will hold water. In equitable distribution states, the judge has the discretion to look at all these expert reports and simply pick a number that feels fair. In community property states, the math is more rigid, but the assumptions used to feed that math are where the battle is won. As we see these experts manipulate discount rates, tax-affecting models, and mortality tables, a clear picture emerges. The 401k is a multifaceted financial instrument that changes shape depending on who is looking at it. But even with the most expensive experts and the most precise valuation, there is one variable that no one can control. It is the human element of the plan administrator's internal policies. In 2026, some of the largest 401k providers have implemented proprietary audit triggers for QDROs that can freeze an account for months if they suspect any form of collusion or non-compliance. In the next part, we are going to look at the dark side of the QDRO. We will explore the historical cases of QDRO fraud, where spouses attempt to use the divorce process to bypass tax laws or hide assets from creditors. We will also dive into what happens when a 401k split goes wrong after the money has already moved. Can you get the money back? Can you sue a plan administrator? We are moving from the valuation phase into the high-stakes world of enforcement and the catastrophic consequences of a failed transfer. This is where the legal theory meets the harsh reality of the banking system. The harsh reality of the banking system is that once a 401k transfer is executed, it is incredibly difficult to undo. This is the dark side of the QDRO process, where technical errors and bad faith actions collide with the finality of federal financial regulations. In the historical context of the United States, we have seen a disturbing rise in cases where the QDRO is used not as a tool for equity, but as a weapon for financial obfuscation. To understand the stakes in 2026, we have to examine the concept of QDRO fraud and the catastrophic consequences of a failed enforcement action. When the legal theory of a 50-50 split meets the rigid mechanical execution of a multi-billion-dollar plan administrator, there is no room for a do-over. Imagine a case study involving a character named Thomas, a high-level executive in the financial services sector. As his divorce from his spouse, Rebecca, reaches its peak in 2026, Thomas realizes that his 401k, valued at $1.8 million, is his most vulnerable asset. Historically, individuals in Thomas's position have attempted what is known as the friendly QDRO, or collusive QDRO. In this scenario, Thomas might try to fabricate a debt or a prior domestic obligation to a third party, perhaps a previous partner or a relative, to have a court order a portion of the 401k to be moved to an alternate payee who is secretly in league with him. While this is a high-stakes felony, the historical data suggests that as 401k balances have grown, so has the desperation of those seeking to shield them from a marital split. However, in 2026, plan administrators have developed sophisticated internal audit triggers. If a QDRO is submitted that looks suspicious, such as an order transferring 75% of an account to an unknown party just weeks before a final divorce decree, the administrator will often place a legal hold on the entire account. This historical shift from passive acceptance to active policing by banks has created a new kind of gridlock. For Rebecca, this means that even if she has a valid claim to half of that $1.8 million, she might find the funds frozen for 18 months, while the plan's legal department conducts an internal investigation. During this time, she has no access to the money, and the market could fluctuate wildly, leaving her with a fraction of the intended purchasing power. Step by step, we must also look at the nightmare of the post-transfer error. Imagine that the QDRO is approved, the money is moved, and Rebecca receives $900,000 into her newly created segregated account. 3 months later, it is discovered that the valuation used in the order was fundamentally flawed because of a clerical error by the plan administrator, who failed to account for an outstanding loan Thomas had taken. Historically, trying to claw back money from an alternate payee, once it has been legally segregated, is one of the most difficult tasks in American law. The plan administrator will often claim immunity under ERISA, stating that they followed a valid court order. The court may try to issue a nunc pro tunc order, a Latin term meaning now for then, to retroactively fix the mistake, but if Rebecca has already rolled that money into a private IRA or spent a portion of it, the funds are effectively out of the court's reach. This brings us to the historical trend of the vanishing plan. In 2026, corporate volatility is at an all-time high. Consider a scenario where the company Thomas works for goes bankrupt or is liquidated during the window between the court signing the QDRO and the plan administrator qualifying it. If the 401k plan is terminated and the assets are distributed to participants as a lump sum, the order is now attached to a phantom. Historically, many spouses have lost their entire retirement claim because they didn't move fast enough to secure a joinder. A joinder is a legal action that joins the retirement plan as a party to the divorce, effectively putting the plan on notice that it cannot distribute funds to the participant until the QDRO is resolved. In the fast-paced 2026 economy, failing to join the plan is a mistake that costs families millions of dollars every year. Furthermore, we must address the data on interstate enforcement. If Thomas lives in New York but the 401k plan is managed by a corporation headquartered in Delaware with a plan administrator in South Dakota, which laws apply when the transfer fails? Historically, ERISA preemption meant that federal law always won, but in 2026, the specific procedures for servicing an order have become a jurisdictional maze. Case studies show that some plan administrators will refuse to honor an order from a state court if it doesn't meet their specific, out-of-state verification requirements. This results in a limbo state where the participant cannot touch the money, but the alternate payee cannot receive it either. The dark side of the QDRO also includes the impact of bankruptcy. If Thomas files for Chapter 7 bankruptcy in 2026 while the divorce is ongoing, his 401k is generally protected from his creditors under federal law. However, if the QDRO has not been finalized, Rebecca's claim to that 401k might be viewed as a simple debt rather than a property interest. Historically, this distinction has allowed some participants to use bankruptcy as a shield to delay or diminish the retirement split. This is why timing is everything. A QDRO that is finished one day before a bankruptcy filing is a secure asset. A QDRO that is finished one day after can become a decade-long litigation nightmare. We also have to analyze the tax penalty trap for the plan administrator. In 2026, if an administrator accidentally pays out funds to an alternate payee without the proper QDRO qualification, they can lose the qualified status of their entire company-wide plan. This would result in every single employee at the company being hit with immediate taxes on their retirement savings. Because the stakes are so high for the corporation, plan administrators have become historically conservative and pedantic. They will reject a QDRO for a missing middle initial or a slightly off-center court seal. This administrative friction is often misinterpreted by divorcing spouses as a personal attack or a sign of collusion, leading to further expensive and unnecessary litigation against the employer. Step by step, what happens if the alternate payee dies before the money is moved? Historically, if the QDRO does not include successor beneficiary language, the money reverts back to the participant. Imagine if Rebecca passes away in a car accident the week after the judge signs the order but the week before the bank moves the money. Without the correct historical clauses, Thomas keeps the full $1.8 million, and Rebecca's children or heirs receive nothing from her 15 years of marital effort. This is the ultimate zero-sum failure of the system. As we examine these enforcement disasters, it becomes clear that the 401k divorce process is not finished when the judge bangs the gavel. It is finished when the digits appear in a new account. We have covered the history, the taxes, the valuation, and now the brutal mechanics of enforcement. But there is one final horizon we must cross to complete this masterclass. It is the future of the 401k in a post-marriage world. In the final part of this series, we are going to look at the 2026 and beyond strategy. We will explore the rise of the QDRO-proof prenuptial agreement and how the next generation of American workers is changing their approach to retirement to avoid these historical traps altogether. We will also reveal the post-divorce recovery timeline, how long it actually takes to rebuild a split 401k, and the data-driven steps to regaining financial independence. We are closing the loop on 40 years of history to show you how to survive the most complex financial event of your life. Regaining financial independence after a 401k split is a marathon, not a sprint. And in the landscape of 2026, the recovery timeline is dictated by a new set of economic realities. Historically, the immediate aftermath of a retirement division is characterized by a phenomenon known as the wealth shock. Data-driven studies from the early 2020s indicate that the average individual takes approximately 7 to 10 years to return to their pre-divorce net worth, assuming they maintain consistent employment and investment contributions. However, the strategies for this recovery have shifted. We are no longer in an era where you can simply set and forget your contributions. To survive the most complex financial event of your life, you must adopt a forward-looking historical perspective on asset rebuilding and protection. Imagine a case study involving a project lead named Alex. In 2026, after a grueling 18-month legal battle, Alex's 401k has been halved, leaving him with $400,000 at age 45. Historically, someone in Alex's position might feel a sense of paralysis, believing they can never catch up. But the 2026 recovery strategy focuses on the utilization of catch-up contributions and the aggressive exploitation of employer matching. Step by step, Alex begins by recalibrating his tax-advantaged savings. Since he is nearing the age of 50, he looks toward the historical trend of increased contribution limits. By maximizing his 401k deferrals and upon hitting 50, utilizing the catch-up provisions, Alex can effectively shield a larger portion of his income from taxes while aggressively compounding his remaining principal. But recovery is only half of the story in 2026. The other half is the rise of the QDRO-proof strategy. As we look at the next generation of American workers, we see a historical pivot toward protecting assets before the marriage even begins. This has led to the evolution of the modern prenuptial agreement specifically tailored for defined contribution plans. Historically, prenups were often vague about retirement, focusing more on real estate or family businesses. In 2026, a robust prenuptial agreement includes a specific waiver of ERISA rights, to the extent permitted by law, and a clear definition of what constitutes separate property appreciation. Consider a scenario where a young professional named Jordan enters a marriage in 2026 with a $200,401,000. To avoid the forensic tracing nightmares we discussed in earlier parts, Jordan's prenuptial agreement stipulates that the opening balance and all future passive growth on that balance remain separate property. Furthermore, it might dictate that in the event of a divorce, The marital portion is divided based on a specific formula that accounts for the time-weighted return of the investments, rather than a simple coverture fraction. This proactive historical approach is becoming the standard for high-earning individuals who have witnessed the destruction of the 401k splits of their parents' generation. We must also analyze the data on the post-divorce investment allocation shift. Historically, individuals who have just lost half of their retirement savings tend to become overly conservative, moving their remaining funds into bonds or cash out of a fear of further loss. Case studies from 2026 show that this is often a tactical error. Because the time horizon for retirement hasn't changed, but the principle has, many recovery models suggest a more disciplined adherence to equity-heavy portfolios to capture the necessary growth to fill the gap. This requires a psychological shift from viewing the 401k as a spent asset to viewing it as a seed that has been pruned but is still capable of reaching its full height. Another critical step in the 2026 recovery timeline is the audit of beneficiary designations. Historically, one of the most tragic outcomes in U.S. financial history is the forgotten beneficiary. Imagine if Alex, after his divorce is finalized and his 401k is split, fails to update his beneficiary form at his HR department. If he passes away 5 years later, despite a divorce decree stating his ex-spouse has no further claim to his estate, the plan administrator is legally bound by federal law to pay the remaining $400,000 to the person named on the form. In the eyes of the Supreme Court, as established in the landmark Kennedy v. Plan Administrator for DuPont Savings and Investment Plan case, the plan documents trump the divorce decree. Updating these forms is the single most important administrative task in the post-divorce recovery phase. Furthermore, we need to examine the role of the Health Savings Account or HSA as a secondary retirement vehicle in 2026. Because HSAs are not technically retirement plans under the same ERISA umbrella as 401ks, they are often overlooked during a divorce. Historically, they have been treated as simple bank accounts. However, for someone like Alex, an HSA offers a triple tax advantage that can supplement a diminished 401k. By maxing out an HSA and investing the funds in the market, he creates a separate, often untapped pot of wealth that can be used for medical expenses in retirement or as a taxable income source after age 65. This is part of the diversified recovery model that is gaining traction in 2026. We also have to look at the historical trend of serial 401k building. In the gig economy of 2026, workers change jobs every 2 to 3 years. Each move presents an opportunity to reset the separate property clock. By rolling old 401ks into a separate, non-commingled rollover IRA and starting fresh with each new employer, individuals can create a clear paper trail that makes future tracing significantly easier. This is the defensive architecture of the modern American worker. They are learning that the only way to survive the historical volatility of the 401k is to treat it with the same level of forensic detail as a multinational corporation treats its balance sheet. As we conclude this deep dive masterclass, we must reflect on the broader historical arc. The 401k began as an obscure tax loophole in 1978. It was never intended to be the primary engine of American retirement, nor was it designed to be the central point of contention in the dissolution of millions of families. Yet, over the last 40 years it has become both. The potential outcomes of a 401k divorce in 2026 are not a matter of luck. They are a matter of preparation, technical precision, and an understanding of the intersection between state domestic law and federal tax code. You now have the historical context, the mechanical step-by-step, the valuation strategies, and the enforcement warnings. You understand that the QDRO is a powerful but temperamental tool, and that the IRS is a silent partner in every divorce negotiation. But even with all this knowledge, the landscape of retirement and family law is constantly shifting. New legislation, fresh court precedents, and evolving market conditions mean that the perfect strategy of today might be the risky strategy of tomorrow. The story of your 401k doesn't end with a divorce decree. It is a living document of your professional life and your personal history. Whether you are the account holder trying to protect a lifetime of labor or the alternate payee seeking a fair share of a shared dream, the goal is the same: financial clarity and the ability to move into the next chapter of life with a secure foundation. We have explored every dark corner of the 401k divorce process, from the initial hook to the final recovery. But while we have reached the end of this masterclass, the application of these principles is where your real journey begins. Stay vigilant, stay informed, and always remember that in the world of 2026, Your greatest asset isn't just the balance in your account. It is the knowledge of how to manage it through the storms of life.